Well, good evening and welcome to this live stream. Can you believe it? 25th of June 2024. Martin North here from Digital Finance Analytics. Great to have you on the show tonight. And we're going to have a really interesting conversation with Chris about mortgage broking and property and what he's seeing. There's a lot of movement, of course, at the moment in so many areas. So we'll be exploring that. Just before I bring him in, let me just remind you, as I always do, that we're not providing specific financial or legal advice. It's a general conversation only. We do moderate the chat too, but feel free to throw your questions and comments in. If you'd like to ask a specific question, use that Walk the World. That'll make sure it goes into my queue and gets to my attention. And I won't necessarily get to it immediately, but if you do throw it in, we'll try and get to it before the end of the show. I've also enabled Super Chat, which means that you can get your question to the top of the list or indeed make a contribution to what we do around here. Always greatly appreciated. We don't do this for profit. We do this because we think there's a really important conversation to be had, and contributions really help us to be able to keep the show going. Right, now let me bring Chris in and we'll get started. Hi, Chris. How are you going?
Martin, always looking forward to these chats. We've been good friends for many years now, it seems. It's probably 5-6 years, I think, since our first episode, and always looking forward to our regular updates. So I hope you've been well over there in the UK.
Yeah, been very well, very busy, running the same surveys now as in Australia and making some very interesting comparisons between the UK and the Australian market. I'd also tell you that I'm quite busy engaging with my Australian audience still too. Of course, we run these shows regularly, but also through the one-on-ones. And quite a few people are quite confused about what's happening in the property sector. So I think we're going to have a good conversation. I also had quite a few questions specifically about mortgage brokers and how to get the best out of mortgage brokers. So we might touch on that because, of course, you are right in the center of mortgage broking. But we should just update people. You've now just migrated as part of your growth strategy to be the Flint Group.
Yeah, absolutely. We mentioned it probably on our last episode about 3-4 months ago, whatever it was. Yeah, I did a merge with another broker. So we went for a team of circa 20 to 40, and then about another 10, 15 people have joined. So we're over 50 now in terms of our team. And yeah, it's been a big few months. A merger is a lot more than I thought goes into that. And but we're getting through the work. We've done probably 10 years of change in 4 months. So when you're under a bit of pain, you might as well just create more pain, right? So, no, the team have been amazing, and appreciate any clients that have reached out. And many have reached out from listening to this over the years, actually. So if you're one of those, we really appreciate you getting in touch.
Well, that's great. And I've had so many positive comments from people who've actually used your services, Chris, over the years. So it's a mutually reinforcing. And I think this is really important for people to understand. Not all mortgage brokers are actually the same. Right. And there are some really, really good ones, and there are some really, really not good ones. And, one of the questions that I actually had, and we might go straight into it simply to sort of start the show, is how do you work out what the right mortgage broker for you is?
Look, it's a big question, right? I do think, like every industry, you get better over time. I'm a much better broker now than I was in 2013, 14. I really didn't know what I was doing. I thought I did, but I didn't. I do think experience matters. And I know it's easy for me to say that when I've got 10 years plus experience and, new brokers are starting. So it's not about saying that they can't do a good job, but I just think you learn a lot over that time because you see a lot of clients. And, I came into broking when I was a financial planner prior. And so I had that sort of background on a financial planning side. Now, so I do think, a great broker probably is coming into it with an advisory background. It doesn't have to be a financial advisor, but some type of, because they need to see themselves as an advisor for you. And I'd say, a great broker isn't just getting you a good rate, isn't helping you pick the right bank. That's like basic 101. A great broker is really being a trusted advisor for you and not just validating and facilitating what you want to do. Is really sort of thinking through your situation and asking you questions that you might not have thought of, and challenging your thinking. I would say that's ultimately what the best brokers do. I do think the broker industry does have a lot of growth left, even though broker market share has been increasing, year on year. I mean, it's at 75% now. When I joined, it was 40, and it, 20 years ago, it was 0. That's a lot of what the banks were complaining about in their half-year results when they were still printing billions of dollars of profit, and they're blaming mortgage brokers for giving Australians a better deal on their mortgage. And a lot of that is because mortgage broker market share has risen. I think the brokers there's not like there isn't any challenges for brokers. There's the digitalization of broking happening at the moment as well. And I think the next evolution of the broker is they have to become a trusted advisor. And we're trying to really help brokers, the industry itself, to try to make that leap. And so not just, getting you a loan, and, a great broker will actually help you structure the loan, right? Like we often spend time challenging clients because they say, no, I want to get a 70% LVR, and I want to do that because I think I'm going to get a 5 basis points better rate. But really, they should have went for an 80%, or maybe they should have considered LMI, or maybe they should have gone interest only, or maybe they should have, secured against this property, not that property, or maybe they should have stretched, even though because there are payments they could have afforded, and they focused on the wrong things. And so we're often challenging someone's thinking around loan structure. And also around the bank they're using. A lot of people sometimes go to a bank because of rate, but they forget there's a process and a credit team, and they may not get approved, etc. So it's a big question. Ultimately, a best sniff test, I would call it, is how quick they try to sell you a product, right? If you call up a broker and you're talking to them, how are they focusing on the decision you're making? And is that the right decision for you? And are they caring about what you buy? A great broker really should stop you and say, hang on a sec, should you really be thinking about buying that property? Have you thought about upgrading your home? Have you thought about buying a home? Have you thought of what are you going to do with that property? They should be challenging you on these things, I believe, rather than just saying, yeah, if that's what you want to do, I'm happy to do an SMSF loan and just, make the deal happen, and not really caring about what you're doing. So I think that's the perfect sniff test, a bit of experience. I do think a team matters. So just having a bit of understanding of, is it just them? Have they got a process? Are they going to be the one calling all the banks? Are they going to be the one guiding you through the whole process? Because I think a team allows that broker to actually get really good at their job and focus at the most valuable parts as well. That would be my take.
Yeah, and I think the point you've made, Chris, there was really, really critical. Finding the loan is right at the end of the process, right? There's an upscale, upfront conversation to be had. And unfortunately, I've heard of quite a few people and spoken with quite a few people whose mortgage broker goes directly to the solution, I can get you a loan, without actually thinking about some of those broader issues, which is about, are you thinking about it the right way? Are you actually taking account of these other factors? Sometimes the right answer is don't do it. And there are not necessarily all mortgage brokers who will say, don't do it, because of course they want to go direct to the solution. So I think that's really, really important that you actually got somebody that you can have that broader conversation with, because if you get the wrong property or the wrong loan, there's a consequence. It's not just a point in time decision. It stays with you for quite a long period of time. So these are really important decisions and conversations. And unfortunately, my one-to-one conversation with quite a few people over recent months have suggested that in some cases, the mortgage broker has not led them in the right direction because that upfront planning piece and that thinking piece was not actually developed sufficiently.
Yeah, I think there's that scarcity sort of abundant mindset. A broker has to have the abundance mindset rather than the scarcity mindset. And, they do have to potentially, be in an established position. This is one of the challenges of running commission-only broking models. And we as a business, we've got brokers that are basically running on that type of model. And, we've got to really educate them that, obviously you want to get your loan numbers and you want to settle loans, but what you really want is clients for life, and you want referrals from your clients, and you want referral partners to trust you. And ultimately what you've got to do is focus on the client outcomes. And I think that's what, as a business, we've just done consistently for, it's actually a decade this week. We're going to be celebrating this little weekend on the with my wife and family. And, that just consistently, making clients feel like they know they can trust you to your advice, then that's what they really want. And I think that's what you really want with a broker. Can you trust what they're saying, and are they thinking about things on abundant mindset and, stopping you making decisions? The reality is people are going to be borrowing money over the future, right? So, someone who's trying to push you a loan to get it today, it's because they're thinking about what their interests are, not about whether they just want to be your partner, your long-term partner around all your finance decisions. And so that's another good little sniff test. If you feel like they're trying to force a product down you and not ask you those big questions. And final question on the mortgage broker bit.
somebody asked me the other day about how do I know whether the mortgage broker has access to a broad enough range of products in the marketplace to be able to get the best product that's out there. And that's quite a complicated question, isn't it? About how many banks you interact with. And it's not necessarily just price, as you said. It could be also degree of service and other factors that actually would steer in a particular direction to a particular lender. And a good broker will have a reasonable spread, but how do you know what their spread is?
Oh, look, most brokers are licensed through a few aggregators, and you've got like a small number of smaller aggregators. I'd say more the established brokers are with the bigger aggregators because of the support they provide. I mean, we just switched from 10 years at Connective. Connective are, got 4,000 plus brokers. There's about 19,000 brokers, right? Connective are an amazing aggregator. They've got a big panel. Pretty much all the big aggregators have got great panels, because if you think about it from a bank point of view, they'd want to get access to those panels of brokers, right? And so there are some small tweaks, like HSBC is only working with a small number of brokers just due to capacity, and some lenders don't want to work with some aggregators because of some conflicts of interest and things like that. So there's definitely some small where you go to one broker versus another. But, if you look at where loan volumes go and look at where, if you break up the total loans or where they go, most brokers have probably got access to 99% of those lenders, right? It's interesting, though. We are seeing more and more of the non-banks come in with sort of a bit of policy innovation and trying to get some market share, not so much on rate, but on policy niches. And, the team actually met up with one today. And I think that's going to happen more and more. They're starting in areas like expats and SMSF and things where the banks don't want to play, the downsizing, the bridging loans, and I think there's more and more innovation happening in the lending space where the banks are simplifying their product lines, if anything, rather than stepping into these more risky lenders. And we're seeing a bit of innovation around, no lending, servicing, sort of refinances. I think that is opening up a little bit as well. And so I think we're going to start to see some longer loans come into the market to increase serviceability and to increase borrowing capacity. So, yeah, the lending market's always changing. But, if you go to most brokers, they're lodging it through the big four, unfortunately, plus your INGs and Macquarie and Suncorp and then a few other lenders and building societies. It's that they would take 99% of their loans, I'd imagine.
Interesting. Absolutely. And I think that the concept of, this broker has a better portfolio of banks than the other is probably something which is past now based on the evolution of the market. So there's other issues, which is the upstream conversation, the contextual conversation is becoming ever more important when I'm trying to pick the right broker. Now, I've got a bunch of questions for you coming in over the chat. This is from Cookie Boy first. Are you, Chris, seeing banks knocking back people even with a good deposit? There was an article talking in the Newcastle area where people had, income was pretty big. They couldn't get a 500K loan. What's the underwriting sort of feeling at the moment?
I haven't seen that article, Cookie Boy, but I don't think so. I don't think that's the case. I think it's risk on for the banks. You got to think it from the bank point of view. If some person's got a big deposit, right? So they're going to be a low LVR loan. As long as they can service that loan, they haven't got massive issues with their credit, the bank's going to approve that loan because they're really low risk lending, right? You got very big deposit plus servicing is so tight at the moment, roughly 4.5, 5 times income, right? It's not 6, 7, 8 times income. And so I'd be very surprised that person is being knocked back. I think it might be a credit issue or something like that, but it's risk on for the banks, right? And banks are actually, even the big players, are doing small tweaks around their policy and exceptions, and and particularly in the private banks are doing things to get loans through based on and yeah, they have to report that to APRA and things like that, but they need loan book growth, right? And you had ANZ came out with this 5% deposit home loans all the way up to $8 million in the last few months. We were part of the pilot on that. There was about 30 brokers on that list. And that was 95% loans up to 8 million in certain postcodes. The further you went down, 6 million, 5 million, etc., more postcodes opened up, but it was obviously, the more higher end of the market. We've also heard, that might be a 95% no, all of my loans might be coming in, at other banks across other price points, etc. And so it's really risk on from the banks. You can see that in terms of their loan book growth. If they can get the loan through, they will. So it's not like a 2018 scenario. And so as long as you present the file right, then it would likely get approved.
Yeah, it's interesting because I've had, again, in my one-on-one conversations, more people have been more successful more recently in finding banks who can provide them with a loan. And I guess that's part of the competitive landscape. CBA said quite recently it's a very competitive market, and we're certainly seeing that with some of the products and services. In fact, Leonie asked this question. It's actually in two parts. What are your thoughts on the big four bank digital mortgages taking back business sales? And by the way, she loves elephant in the room. And then she added, should read big four banks. So this digital mortgage concept, in other words, going back to the banks rather than via mortgage brokers, what do you make of it?
Look, it's actually really good for consumers, right? More competition. The banks are actually just cannibalizing their own books. It's not the greatest of strategies, if I was the bank CEO and I've got customers who trust my brand, right? And then I go and offer cheaper product online. It's much cheaper than what you're offering me in the branches. You just get a refinance to it. I think all these digital lenders, we've been speaking to a number of them because we want to be on that disrupting ourselves curve rather than getting disrupted in a few years' time and going, how the hell do we work with digital banks and digital broking? And they all really struggle to get fund flows, right? Direct to consumer, right? It's hard to cost of acquisitions actually really high. The only one that's really probably doing really well is a Up Bank. I'm not sure if anyone's downloaded the app. It's a pretty sexy bank account. I joined it 4 or 5 years ago when I was tracking all this stuff, and they've got 900 or 850,000 people on this banking app, and now they're selling them home loans. And they've got a real raving fan base. So I think that's one to watch because they've been able to get customers for like $50 a pop, rather than what a lot of these digital lenders have to do, like the Athenas and the 86400s and Volt and Zinja. And so I think, and then all the big four banks doing digital home loans. I just think that, you're not going to get choice, right? So someone's going to go online there if they've got a very vanilla deal and they know they're going to get approved, and absolutely they may do it, but broker market share is 75% for a reason, and that is down to choice. So what you'll find is the banks will struggle to sell their loans direct to consumers. And what they'll do is they'll have to sell those digital loans through brokers. So digital loans will go first there. And then when they they've proven that they can do 10-minute mortgages, which they've been promising for years. They'll then get wrapped up in some type of mortgage aggregator sort of digital loan option. And so that's great for us as brokers, right? We'll be able to give instant credit decisioning, an instant pre-approval and instant refinances across a broad number of banks. And I can't say too much, something we're working on, but we're actually working on something similar to that internally because I think that's really valuable. And I think that's where the finance industry is going. It's not that far away, if I'm honest. You saw Lendy do a instant refinance tool with Pepper a few weeks ago. And, you've got the DigiLoan with CBA, you've got Unloan, all the stuff that Timely's doing with NRMA and Qantas, etc. So yeah, we are going to go into a world where you can get fast mortgages, fast pre-approvals, but the broker's still going to drive that conversation, and we're still going to be the ones because we've got the market share. And as a consumer, you would say, well, yeah, I want digital and I want speed, but why would I go direct? Why wouldn't I go to a broker who can guide me on that decision and say, you know what, that's not the right structure anyway. I'm going to go with this bank, and maybe I'm going to do it across 2 different banks, and et cetera, et cetera.
Yeah, and my observation there is that the digital loans are okay for vanilla, requirements. But if you've got something which is a little bit different or a little bit unusual, you probably won't be able to get that through the digital channel, at least for now. But I remember, was it 10 or 15 years ago, I ran some seminars with CoreLogic, and I was arguing then that in theory, you should be able to actually do a 10-minute loan. All of the components were there even back then. It's just putting all the pieces together and making the digital work appropriately. And I think finally now it's getting there. And by the way, in the UK, that you can pretty much do the same, but only for certain types of transactions and certain amounts, and so it's a bit more cookie cutter.
I think it's going to get broader. A lot of the broking industry sits on that and they think they're safe, right? And they say, oh, yeah, you can do the digital loans, but it's only vanilla, right? And, it's not, and my loans aren't vanilla, right? There's always a complication, which is the truth, right? There always is a quirk to every application most of the time, whether it's casual income or bonus or self-employed or credit issue or the type of property or, just something, right, that we have to sort of justify that a credit assessor is going to want to check, right? But I do think what they're going to be able to approve is going to get broader and broader, particularly when you can stack lenders on top of each other. So this lender wants to play at this part of the market, but now I've got a digital loan for this part of the market. I've got a digital loan for this part of the market. And so then us at brokers can approve a lot more loans because we can stack it. But that's absolutely the experience a lot of these digital banks is they promise digital and then you go through the application and you set off one of the alarm bells and then bang, it's no longer digital, it's humanly assessed. And then you're back just like a normal home loan in a queue employing people. Yeah, we're not too concerned because, whatever they do build for consumers, they'll end up having to just build, offer that to brokers. And so we actually love all this stuff because if you think about it from our point of view, if we need less people to process loans, less writing, lodging loans, that builds a bigger margin for us. And this is probably an interesting point to discuss. There's been a lot of the talk of the banks throwing brokers under the bus in the last, when they released their profits. And what you need to look at is net interest margin for the banks has been going down in line and in correlation with broker market share. And I think what the broking industry is going to have a bit of a battle on is that just because of the power the big banks have, with loan volumes, with profits, with governments, with media, you can already see the PR campaign coming from the banks to blame brokers and come up with, stories on, how easy it is to be a broker and how much money they're making and all these, false stories to blame brokers for how they're not making as much profits. And so just be a bit wary of that as a consumer. Obviously, I'm coming from a very biased point of view, but you just have to see that PR campaign is really going to pick up over the next few years. Very similar to what happened in the Royal Commission. Banks are going to blame other people rather than say, actually, the reason our clients are going to brokers is because they provide choice and they provide service and they give us a relationship long term and they care about what we do and they give us good advice. And the banks really, what are they just offering a product, right? And so that's the battle that brokers are going to have over the next few years.
Yeah, I think you're right. The PR will be ramped up for all sorts of reasons, not least if banks are required also to keep branches in places they don't want to keep them and maintain access to cash and all those things that are sort of in play at the moment as well. Now, here's another question for you, Chris, from Bossman. Actually got two parts. Let me take the second part first. Does a mortgage broker get paid only on approval? So when does that remuneration process start? And then the other one, more broadly, is if the Australian housing market is to become more available to citizens only, would writing bigger loans increase? And I guess more broadly, what are you seeing with larger loans, the ninja loans as they're so called? Are you seeing any of those at the moment?
So the first question around, do we get paid early on approval? Actually, we don't even get paid on approval. We get paid on settlement, right? When I joined the industry, I came from the advice world, which I mentioned before, but I did look at it and go, oh, that's a bit not right. We got paid on cash out, even though they haven't used the money. Oh, we got paid more at this lender versus that lender. Or you can actually borrow a lot more at this bank versus that bank. Because I just came in a bit naive, to be honest. Even though I was doing meetings with mortgage brokers, it wasn't until I got into borrowing capacities and started doing testing on scenarios and start going, hang on a sec. And bit by bit, they started getting ironed out back in 2015. And one of the things that absolutely was a conflict of interest prior to a lot of these changes is that you actually got paid on cash out. And while getting cash out is often the best practice on what you should be doing, it's a buffer. You're releasing equity, you're resetting your loan terms. As long as you're not spending that money, it's good risk management. And a lot of people going into the last few years who did that, who then got surprised by higher interest rates, they're the ones who easily hang on over this period. And so, but that was a conflict of interest because the best advice was also in our interest. And so around getting paid, it's on net loan. It's not on loan approval number, and it's based on the settlement. And it's not based on approvals. And that's a point. Brokers do a lot of work, meeting customers. Only a certain portion of those will go ahead with that broker. Then they get the docs, they request docs and they don't come back or they're not right. And then they chase the customers. Then they send them a strategy and then they don't go ahead and then they go to another broker. And then we don't get this problem as much, but this is what a lot of brokers will do. Then they lodge a pre-approval and the person never buys. And so that's just, and then the person who does buy, yet then they end up getting a loan down the line and they're getting paid. And that can sometimes be years after all this service. And they do that on a goodwill basis, hoping that when you do buy that you use their service. So they don't send you a bill. They don't send you every 6 minutes you chat to them. They're charging you for that. And so, yeah, it's a big misunderstanding with brokers on how they're paid and the challenges of actually getting that money.
Right. But it's also, I suppose, worth noting that there's also a recurring component, isn't there? The continuing commission, which is also something that people sometimes aren't familiar with or aware of. But for as long as the loan is in place, you continue to receive a stream of income.
Absolutely. And this is a real challenge around client retention, right? Like, what are you doing to your customers to make them want to come back to you when they get offered a better rate? Because consumers are hit with better rates every day. Like, if you actually put your mind, focus on this, right, and look around and go, what banks are advertising to me? You'll find that it's on your TV, it's on billboards, it's on buses, it's on your social media, it's all everywhere you're looking, because it's just such a big part of overall economy, right? And so I think you'll find that consumers are hit with better rates all the time. And so once they do waken up and they go, I can get a better rate and the bank's not giving a better rate, do they go back to the broker or do they just refinance a loan? And so this is where a lot of brokers really struggle is, they're getting people in the front door, but they're losing people out the back door because they didn't build any relationship there. They're not adding any value. And the customer then just walks into a branch or goes to their friend's broker they met at a barbecue who gives them a better rate. And so absolutely, the best brokers in the country spend a lot of time focusing on repricing their customers, keeping in touch, adding value at certain parts along their journey. We've got a very, very high retention rate. I'm not just saying that because I'm on here, but I think the reason we reprice and we do those things, but I think people know that when they want to re-look at their loans, that they can come to us and we'll give them really good advice, and they don't want to lose that relationship. And I think that's a real challenge for brokers. But that money only stays there while the customer stays there. And I would just say that the cat's out of the bag with refinancing, and it's getting easier and easier to refinance. I mean, it's hard at the moment with servicing and pricing, but with this digitalization and open banking in the future, unless you're adding value, clients will just go elsewhere.
Yeah, and rightfully so. It's about
absolutely
value for money, and also I think the relationship side of it is something which people probably have undercooked, but I think going forward will become ever more important. Now, Cookie Boy, back on the questions again. Are you seeing a wave of refinancing, like going from cheap fixed to a higher percentage variable and those sorts of things? So, rates are higher for longer. The expectation now is that interest rates probably won't get cut until maybe next year. What's that doing in terms of people who've moving from the cheap fixed into variable, and overall refinancing is down a bit from where it was, I think.
Yeah, the bank's kind of lost out on this, which obviously we don't care about, and we're actually happy because our clients are the consumer, right? So the banks, obviously did really cheap fixed rate home loans all through COVID, and vast majority of people took them up. Not just new lending, existing lending, right? There was obviously fixed rates at 2% for 2, 3, 4, 5 years was a pretty good bet. And lots of people took that up, right? And that was a fixed rate cliff that potentially, there was a lot of talk about that for many years, right? And so that's been slowly unwinding. And as people have come off that fixed rate cliff, they've come onto variable rates. And if you're coming off this year, it's not that great, right? Because, repricing your loan in 2024 isn't as sharp as last year. The banks got ahead of the curve, and I think they were so fearful that as people came off their fixed rates, they were going to refinance to other banks, and their loan book growth was already struggling because the market's not lots of listings and lots of transactions. And so they were like, well, we're just going to focus on retention. And the banks were in a total war with each other, offering discounts that were just ridiculous. And they were repricing customers, even if they couldn't refinance, which hadn't happened in the past. Often they would hold off a better deal on playing on your apathy and basically playing and a bit of a game of chicken. I'm going to offer you, 6.2, knowing you can get 6, but I know you're going to be lazy and you're not going to refinance it, right? That was their game before. And, in the 2023, they just repriced everyone. And we went through our whole book of customers at every bank and repriced everyone. And they're all on better rates than you can get today. They're all in sub sixes, and getting sub 6 right now is really hard. And so, yeah, that's what we're finding with refinances is the rates are actually pretty good if they have repriced 12 months ago. If they're coming off now and they haven't repriced, they are in the low sixes, but they're really struggling to refinance because of servicing, particularly the bigger loans, because servicing's gone from 6, 7 times to 4.5, 5 times, and probably a bigger drop than that in fairness. Tax cuts are coming through next week. That's a 5% increase roughly to borrowing capacity, not ridiculously high. But I do think as people keep paying off their loans, equity is not really a problem due to prices on lots of locations. They're getting wage increases, they're getting bonuses, they may be switching jobs and, getting a bump up. Maybe a wife or husband's going back to work after kids and they're full time. Their servicing's going up for those reasons. And then if you start to see that, rates are starting to come back down, maybe it's not next year, maybe it's the year after, there will be a bit of pressure on APRA, particularly because of our construction industry is based on people being able to borrow, particularly first home buyers, and upgraders to a certain extent because they've been pushed out of buying houses. And so now they want to buy, sky homes and 3-4 bedroom apartments that, they can't afford to buy. And so I think to support the construction industry, and also that we're in a rental crisis, there's going to be a bit of a pressure to relax that serviceability buffer. And the argument's going to be that it's, not a real risk to the bank because of, the amount of equity in the property market. And so that'll very quickly get factored into prices very quickly. Like if Liberals win the election next year, even though it's unlikely, getting access to super would very quickly get factored into prices as well.
Yes, and of course, there was that through COVID when people were able to pull money out of the superannuation, and quite a few people did, and use that then to get into the property market.
Yeah.
And it's interesting how Liberals are, playing up the difference now between the Albanese housing strategy or lack of it and what they're actually arguing for. And Senator Bragg in particular has been talking specifically about, locking people into the rental market forever. And, we're going to be the party that actually is going to support the ability to be able to purchase properties. So you're going to expect, I think, some more sort of stories like that coming out, particularly as we see the election, because housing is going to be a big part of the next election campaign, like it or not.
Yeah, I thought it would be a big play in the budget. It was, I remember just watching it and going, what are they doing for housing? What are they doing? And it was very tame. I mean, since then, though, you have seen a lot of the state governments have released their budgets and they've been very pro-housing, I do sort of always laugh at what they do, though. There's always a push to new property, first home under grants and stamp duty concessions if you buy new, just because of the amount of money they make in you, right? It feels like a free kick, but whatever they give you, they're making, tenfold of that in terms of other taxes, etc. And so, yeah, that's always a bit of a, they have increased the limits for also established properties and things like that. And, in Tasmania and Queensland. And so, yeah, but there'll be a bit of a push for that. And I do think there is a bit of a pressure on land tax, right? You saw this New South Wales government didn't increase the thresholds, right? And they say the thresholds are going to stay flat. Victoria reducing the thresholds for investors. And that's a very interesting play. And then, investors are saying, hang on a sec, it's just another whatever the straw that broke the camel's back, I think, down in Victoria, and a lot of investors are bailing. And the budget was really dire, to be honest. I do think they're going to have to come up with something, right? To go into the next election, particularly if the Liberals make that as such a big gap. I guess it just depends on what the numbers are going to show. If they're going to get enough votes, Liberals are going to see, well, if it's helping first-time buyers, it's probably helping my property prices as well. And so self-interest will probably be a good vote there as well. They also probably don't want to be giving money to their kids. And, the amount they're having to give, we used to see with the wealth transfer, which is such a big point All the reports sort of said, in the 2030s, this was going to be a big discussion point. If you listen to the Bernard Salts of the world and demographers, or you listen to the wealth management industry, and they were all saying, 2030s was the year that it was all going to get passed down. Was 2024. It's getting passed down pretty fast right now. And I don't think the parents and the grandparents want to give the money down. It's just that they can see that they're struggling, whether they're in rental accommodation or whether they're stuck in an apartment, or they've got now grandkids that or they're just having a cost of living challenge with their mortgages, and they're helping their kids with their mortgages, not so much the deposit. And I think that's really amazed me. And, when you look at the property market and the equity market and super, et cetera, and the amount of wealth there, it's surprising. It's not surprising, just how fast it is coming down. And the haves and have-nots is actually getting a lot worse.
Well, absolutely. Yeah, we see this big division between those who can and those who can't. And the banker mum and dad, or the family bankers, I prefer to call it now, is a really big thing, right? More than half of those who are buying into the market for the first time are getting money from, elsewhere. And the issue there is, of course, that that is in turn creating a bigger gap between those who have family wealth and access to family wealth and those who don't. The other observation is more generally that if you look at the spending trends at the moment, those in the sort of 50s plus and maybe who don't have a mortgage and don't pay rent are still spending very freely. And that's one of the reasons why the inflation momentum is quite strong at the moment. On the other hand, those further down the generations, those in the midst of trying to buy or recently bought, are not spending because they don't have capacity to spend. So once again, we're seeing this big divergence between different groups. And, I guess, I don't know what you think, Chris, but the social division that's being created, I think is quite worrying. When you see people living in tents and when you see people struggling with trying to find somewhere to rent. But one of the observations I do see is those in the rental sector are really rabid to just try and buy anything to get out of the rental sector, to try and jump over to buy something. And unfortunately, sometimes what they buy is not necessarily a good buy.
Yeah, a lot of people like to say, well, the migration's the reason how prices are going. Well, what are the migration doing, right? They're not buying, right? They are answering to our rental demands, right? This is why you saw some pressure to reduce caps particularly around uni students, right, in recent months. But that rental crisis isn't just because there's more demand in the rental market, right? It's also because investors are selling, and I think that's the real issue there, is that you're seeing a tightening of investors bailing out of the market because their homes are. They might just want to take their profits, or maybe there's no profits there. They can't afford the mortgages. The rates have gone up. The rates haven't gone up anywhere near as much. They can't afford the negative cash flow. The issues with land tax and other things. So I think you are seeing a lot of investors bailing out of some markets more than others, and investors are just due to capacity, due to the ability to sustain a negative cash flow. And also just this, the lower end of the market, particularly the sort of the lower 25% quartile of the market is where you got a lot of first home buyers playing in that market. But so also you're seeing, a bit of growth in that market compared to sort of the middle 50 and the top 25, which isn't usually what happens in upswings. Upswings usually get led at the top, but it's getting led a little bit at the bottom end. And so I think a lot of investors are trying to capture this affordability wave, and they're going where it's high yielding, particularly in places like Perth and Adelaide, etc. So you're getting this reallocation of rental supply, right? So, every time an investor bails in a market, that's one less investment property, particularly if it gets sold to a first home buyer, right? Yes, that first home buyer may be in a rental accommodation, but maybe they're not. Maybe they're flat sharing. Maybe they're living at home. Maybe they're living overseas. And so there's not always this one for one demand supply sort of exchange. And so I do think the rental crisis, just if you think about it, what's worse, like when you're owning a home, do you really want to list it, sell first, go into the rental market, and then try to rebuy? And people have been caught out so many times and be surprised what happens with the market. And so they're already scared of doing that. But the rental crisis, further exacerbating their desire, reducing their desire to do it. So you're seeing that Mexican standoff, particularly in the housing market. But you're also seeing at the lower end is a lot of first home buyers, and particularly as they get into that housing, family formation stage. They just really want security, and they're actually doing more compromises than I thought they would under higher interest rates. So I said that, a few years ago, high interest rates are going to make people pickier, and they absolutely have. So not every property is doing well. Things that are very compromised, poorer parts of the suburb, busier roads, dark, things that need a lot of work, etc. They're beating to a different drum, right? And they're the ones that are sitting on the market. But the A's, and it's stretching into the B's and maybe the B minuses now, are still getting snapped up. And that's because, a lot of people are saying, well, I really won't be able to make that move into that better property. I can't find them. It's not in my budget. I haven't got access to family wealth. I need something. I've got a rental crisis. I don't want to go through that again. And I just want to secure something. And so I can see that particularly with our purchases. A lot of them have been in around the market for some time. And, they've been watching and they've been burnt, and they probably wish they did it years ago. And rather than just that person, maybe I've got to that stage of life where I should buy a property. That sort of person probably needs to be, go through a bit of pain, I would say. In terms of looking, I think they're a little bit less likely to make those compromises. But yeah, those compromises are absolutely happening right now. Not to every extent. You can easily see, and I think the median prices, we spoke about this coming on, is you're just not seeing if you look at a suburb and you look at the best streets and the best sides of the streets and the better blocks, they're not the properties selling right now, because that's what's really frozen. And so, but if a property isn't on the best street, and maybe it's not someone's forever home, if they are under some financial stress, they're willing to just get out of that property, because they're like, well, I'm not going to regret that property. It wasn't really ever my dream home. And also, they're the ones who really want to get out and get into a better property if they can. And they're willing to go into the rental market because they don't love the property they own either. So they're willing to take that gamble. So that would be my observation. So that's actually reducing. So when you look at median prices, it's actually slowing down the growth on paper, because the market is a competitional bias, right? There's a bigger percentage of properties selling on this part of the market, so that's reducing the median. Rather than in booms, it happens the other way. A bigger percentage of better quality properties sell, and medians actually look like they're growing faster than they probably are. And so that's another thing that I've noticed recently.
Absolutely. Well, the generic indices don't really tell you much, because the compositional stuff changes quite significantly, and that's not always captured. But you mentioned compromise, and I just want to unpick that a bit more, Chris, because I guess one of the biggest conversations that I've had through my one-to-ones in recent months is you can't necessarily get what you aspire at the moment. So what are you going to compromise on? Is it going to be location? Is it going to be size of property or type of property? Is it going to be further away from, your job and therefore more travel time? Those questions are quite difficult for people to get their head around. As a mortgage broker, do you sort of touch on any of that, or do you just say, well, sort that out? Because it seems to me that that's got to be a part of the conversation.
Oh, absolutely. I mean, people have been making compromises for years, right? But I think particularly right now, when they're just numbers aren't adding up. And so people are saying, look, I could wait, right? I could wait for that pay rise. I could wait for borrowing capacity to be higher. I could wait for that money to come through some bonuses at work or something like that. But it's just not going to move the needle much, right? And the worry is that if you wait for those things, does the market run on you? So you kind of go, well, this is my budget, right? And so you're right. Like, I can compromise on location. I can compromise on parts of that location. I can compromise on the type of property, from a house to an apartment. I can go from a bigger apartment. I can go to an apartment without parking. I can go to a poorer street. I can go to high density. And all those compromises need to be really, really weighed up, because, particularly, John McGrath, bless him, he actually wrote a really good article on this a few years ago. And, he kind of hit the nail on the head. Sometimes people will make they make so many sacrifices to be in a certain suburb, right? Whereas, sometimes those sacrifices aren't worth it. You're actually better to switch suburbs. rather than buying the worst street and the worst aspect and the noisy and the weird block, just to buy the suburb or the postcode. And, sometimes you're better off to not make that compromise and going a bit further out and, getting a bit better property in a cheaper location, maybe a bit further away from the city. And we're starting to see people make the compromises on getting away from, like, a big compromise. If you're still, let's say, living in Sydney, right, you might go, well, my friends, my family, my friends, my networks, my work, for example, is in Sydney. And we've seen the wave out of Sydney kind of goes on flows, like 2016, 17, a lot of people going to Brisbane and then they weren't. And the Sydney prices got cheaper, so everyone was back buying in Sydney. And then COVID happened and everyone left Sydney and went to Byron and Central Coast and North of Wollongong, etc. And then they went back to the cities in 21, 22. And I would say right now the wave is starting to go regions again, just because people are like, well, I'm not getting what I want in the capital city. And even though I'm a bit of pressure to get back to work and return to work, I just need to do what's right for me and my family. And we need to secure something. And we ask people, going to the Central Coast, down the Southern Highlands a bit, Blue Mountains, down towards Wollongong again, because people are trying to get ahead of it and they're looking at what their options are closer to the city and they're just not finding they're able to meet the market. And, that's naturally going to happen, particularly as prices run and all their options get removed and they get further along in their life. And that's the thing to remember with the market is that, yes, you've got buyers who need to buy today because that's where their needs are, but you've got buyers who probably wanted to buy 5 years ago and they're finally now in a position to do that. So that's pent up demand. You've got buyers that, really need to, they've got kids in a, 2-bed and the kids are getting, want their own rooms and, and they really probably wanted to do it a few years ago, but now they're forced to do it now. And there is always an internal sort of pent up demand in the market.
Absolutely. And I always say to people, everybody has to make a compromise on something, even if you're spending 5 million, 10 million, 15 million, there's always going to be something that's not quite right. So the ideal property doesn't exist. It's always a matter of a bit of a trade-off.
It's very true.
Yeah. Now, Theo asked this question. I don't know the answer. You might, Chris. They're talking about capital gains and losses, and are there any changes afoot about capital gains and losses on property? I'm not aware of anything specific at the moment, but I don't know whether you are.
Oh, look, that was obviously a talk around the last election, 2019, I think it was, wasn't it?
Yep.
Around the change to capital gains tax. And yeah, look, I mean, I personally think that one probably makes more sense right now, is that rather than the negative gearing thing in a rental crisis. I wouldn't be surprised if it does pop back up over the next few years, but I don't think it's something they're trying to take to the next election. But, when you've got capital gains getting taxed at 20, 25%, you've got income getting taxed at 40 to 50%, it makes sense to potentially make some changes to capital gains tax when the governments are in a lot of debt and the wealth effect, etc. And so I don't think that one's off the table long term. I do think it's going to come back at some point.
Yeah, I think that's probably right, but I don't think there are any concrete plans at the moment. And of course,
yeah,
a lot of politicians have quite significant capital gains because they are very big property holders generally, which may influence what they do.
Grandfathered, Martin, they'd be grandfathered.
Yeah, exactly right. Yes, if you're a politician, then you have a different set of rules. Fraser just made this comment about Victoria. I wouldn't be buying in Victoria, too many regulations and taxes. We might just touch there. There is definitely something different going on in Victoria relative to, say, Sydney or even Western Australia at the moment, isn't there? There's something weird going on.
Look, I probably agree. I disagree with Fraser. I think, particularly if you can get into the Melbourne housing market, when you forecast, we look at forecast, but you look at the forecast of population growth and, the diverse communities down there and people moving to the countries and people who are from Melbourne want to live in Melbourne, and Melbourne gets its mojo back, and just the diversity and employment and really their lack of, land in more premium locations. They have got obviously the biggest cities in the world. I don't know if it is the biggest city in the world, the greenfield sites, and, it's a very flat area you can keep building. They can build high rise, they can build new townhouses, etc. So I'm particularly talking about the housing market. And, more and more investors are bailing on the housing market, A, because of affordability, B, because of things like the land tax changes and They just haven't had the returns down there in recent years, and a lot of investors are going to other areas, right? I think you're going to start to see some more and more a bit more of a rental crisis down there, particularly in the housing market. More and more people just through generations looking to upgrade into the housing market there. And so what I'm talking though is if you're going to buy in Melbourne, you're buying in an area that higher income couples and families really want to make it their forever homes, and so they're forever suburbs, tightly held. People don't really want to leave. And so even as they get older and as they have grandkids, they sort of stay in the homes, etc. So, single level sort of cottages in, maybe the inner north or inner west of Melbourne, or sort of down the Bayside along the train line, sort of to Frankston, etc. Where it's still easy to get access to the city. You've still got access to good schools, and you've got lots of heritage overlays, and bit by bit, people are sort of renovating these homes. And so I think that, personally, I think, you've got great buying conditions. What you actually want is not conditions like are in Perth right now, where you've got a FOMO in the market, low listings, people just paying overs just to get into the market. And, on after, 80, 90% growth, I don't want to, some suburbs have grown that in 2 years, right? And so that's the market you don't want to play in. If what you want to probably play in where it's favored more towards better buying conditions, and you're more likely to have a higher chance of getting a quality asset. And I think Melbourne's got those right fundamentals right now compared to other cities. So it's counter-cyclical play. Yep, you might not see those returns in the short term, but with property, it's not trading properties. You're buying assets that you want to hold long term, and yeah, you might need that more growth to buy other properties. I think that's a bit of a myth, to be honest. I think what usually stops people buying property isn't growth. It's actually just they cap out on income and capacity, and they've got access to more growth, but they can't actually use it to get any further assets. So what really a lot of investors should be doing is just using their capacity wisely, and buying something that they can hold long term. And so less focus on what's going to happen in the next 2 years, more what's going to happen over the next 30 or 40 years. And that would be my bet. I think Melbourne's actually a good option right now.
Yeah, and you've made a really, really important point, right? What is the right time horizon over which to think about a property transaction, right? It's not a few months. It's not even a couple of years, right? My belief is it should be a minimum of 5 years and probably closer to 10 years. And that gives you a completely different context to what good value is, or what good value might be. And I have the view that Melbourne prices will probably continue to wobble sideways for the next 2 or 3 years, but later on there will be some upside. And given what we're seeing in terms of listings in Melbourne, which is quite high, a lot of it is actually ex-investment properties at the moment because of some of the changes that the government's made to the requirements relating to investment properties. That will actually reduce the supply of rental property as well, by the way. But it does mean that if you look carefully, you can find, some interesting opportunities. But you've got to have the right time horizon in mind if you're going to do that.
Yeah, I think investing is actually even a lot longer than that. If you've got a great asset, you'll get down the line. So why would I sell it now? I think why people have shorter time frames is their assets aren't performing. I mean, all the ATO stats, everyone would know this, that amount of investors have got more than 2 properties, right? It is very few. Amount of investors actually lose money on property. You just have to download the CoreLogic Pain and Gain report to see that it's not all rosy, right? And that doesn't include stamp duty and selling costs and holding costs, right? So those numbers should be way higher than they actually are. Been arguing for them to actually do those. To show the real numbers on what people are losing on property if they haven't been gained. And so you do, if you get a good asset, what you'll find is that you do start to get the returns, right? Because it has got scarcity, it has got the right demand, it has got growing demand, it's got shrinking supply. And, I haven't mentioned about turnover rates. Like, I mean, Melbourne, you are still seeing a decent amount of listing of housing and apartments. But if you look at the Sydney housing market and the apartment market, there's a tale of 2 stories. And Brisbane in particular, if you jump on SQM and look at listings on houses and apartments, you'll see that houses up there are just so tight. And what we're seeing is that, the turnover rate, how long people are living in their homes and how long people are selling and upgrading, people are living in their homes longer and longer. And so what's happening is shrinking supply. People are getting locked in their homes. And yeah, they might want a bigger house in a better suburb, but that's just off the table. So we just make do with what we've got right now. And maybe we do some renovations to it, but we're not moving. That desire just to consistently upgrade over time, and maybe we'll sell that and move this place for our kids' high school, and then we'll move somewhere else. And all the transaction costs in doing so, that in itself slows down that desire to move. And so I think, with investing in and buying assets, it should be even a lot longer than, because most investors in property probably should be in the sub 50 range. I mean, yes, you potentially could use it, in your situation when you're in your 50s, but often you're missing a lot of other tricks. Superannuation, using equities, commercial starts to become more and more enticing as you get closer to retirement. You should be buying your downsized apartment. So it's usually people in their 40s and 30s. A lot of 30s are struggling with the challenges of actually getting a long-term home for their family. They start a little bit later, they've got to start a property and they want to get a home. And so their ability to invest is usually constrained, particularly if they're living in the capital cities. And so you're getting a lot of investors in the late 30s into the early to mid 40s. And so if you think about their time frame, well, 10 years is great, but why would you sell your property in your mid 50s, right? If it's paying itself and it's, it's not costing you huge cash flow and you've got your mortgage set up and you've reset your mortgages up for 30 years, you'd go, well, hold it for another 10 years. And then you get to your 60s and now you've been holding it for 20 years, right? Now it's giving you a bit of positive cash flow. You've reset your mortgages prior to stop working, right? So you're not having to, you go, well, I'll try to hold it for another 10 years because I've now got access to my super and I've got other assets. And now, now it's even paying itself even more. And why don't I just hold it for another 10 years as my super starts to dwindle? And I think that's really the mindset, right? I believe to get it right. And what you really want to bet is something that's going to do well over those time frames. Because the good thing about properties, you don't pay capital gains tax till you sell. Whereas shares, you're constantly rebalancing your portfolio and you're sort of losing a bit of your growth along the way because you haven't given it to the tax man. Well, what you can do with, properties is, get that growth. You can actually refinance it and take equity out and reinvest it into shares, or you might buy another property, or you might upgrade your home or renovate. And you're not paying tax on that growth until you actually sell that property. It's a big advantage of property over other asset classes.
Yeah, not all asset classes are created equal. It's perfectly true. Now, Pranav asked this question, which is an interesting take on it. I've made some bad financial decisions in the past 3 years, lost a chunk. How will this affect my borrowing capacity if I go hunting for a loan? I guess there's a couple of issues there. One is the credit rating and the other is capacity.
Look, Pranav, everyone makes bad decisions. I think the most important thing is going forward. What are you going to do, right? And taking those learnings. And and so I think you're thinking about things, the right things. You're moving on with it, right? And you're making better decisions. And so it depends on what those decisions were. I mean, Martin mentioned the points there around credit, and some of those things are hard to unwind. I actually was just on the chat with the team, and a client had some major credit issues just in recent time. We sent them to a credit repair specialist. There's a lot of companies that do that, and often they can work wonders and get defaults removed and get payment missed, and they can fix your credit file. So if you have got bad credit, definitely try to speak to these people. But this person couldn't get fixed. And so sometimes you just got to go through the pain, depending on what's happened to your credit file. But let's say it's not credit and you just haven't got as much cash. Depends on what's happened to your income as well. Like, might be some bad decisions around, maybe you started a business, or maybe you took a gamble on a startup job, or I don't know what happened. So that's what's really going to affect your income the most, is your income. There is a little bit of capacity changes once you get under lower LVRs, right? Because your rate gets better and it's lower risk rating for the bank, etc. So maybe if you haven't got a 20% deposit, that's affecting you a little bit. But mainly the thing that drives your borrowing capacity, which I think your question's regarding, is your income now. And so what you really want to do is, get onto an income structure that's going to be enticing from a borrowing capacity point of view. And, hopefully, but that would be my observations.
Yeah, and I think also time is a healer as well when it comes to this too, right? So it's sometimes a matter of just taking a little bit longer to do things, but keep plugging away is, I guess, the the bottom line. Here's an interesting one. Fraser asked, are banks hiding large defaults by playing games? Don't think they are in the property sector at the moment, because there are some really tight regulations in terms of what they do. But they do have this capacity to go through the hardship program and to, I call this extend and pretend, so give people the opportunity to take a loan for interest only, or for over a longer period. And there was an article the other week suggesting that people were extending their loans by at least 5 years and reducing their interest payments. But ASIC did also say that for many people, 12 months of hardship support is not necessarily going to change the outcome. At the end of that, the banks then say, well, sorry, we've helped, but now we've got to try and actually encourage you to sell. Certainly the thing that I'm seeing, Chris, I don't know whether you are, is forced pressure from the banks to sell, not foreclosure by the banks. And this is ahead of defaults. So they are trying to, I think, sort of direct the traffic before the defaults go up, although defaults are rising just slightly at the moment.
Yeah, it's an interesting one. I do think in the construction space, there'd be some real pain going on, right? We all know about the insolvencies there and the challenges there. And not that I wanted to answer this question like a good politician and completely side rail it and take it to a different direction. But, the challenges in the construction industry is absolutely, something that's playing on people's minds, right? But if we answer your question there around big defaults, look, I wish I could say, and this has just been true, we just haven't got many clients that are going through this. The clients that did really leverage up really hard in 2020 to 2022, a lot of them did that with the idea that their incomes would, go up over the next few years. So they were confident around their income, and a lot of that has actually paid off, whether they're business owners or whether they're employees, and they were at a high. They still had a good trajectory in their income. They were working hard for that next role, and so we're just not seeing that. In saying that, though, we have had a bunch of clients come to us over the last 6 to 12 months that are struggling a bit, right? And we have seen a few clients that weren't clients of us before, but have come to us, and they're doing some what we call down trading. So or downsizing, but they're not downsizing when the kids have left home. They're downsizing even though the kids are still in the home. And so, those compromises that we spoke about before is they're saying, look, do we really need this house in this suburb? And we're going to get ahead of the curve here. And we just know that we can't afford to live here anymore. My income's limited because of, what I do for work. I can't just increase my prices, 40%. I can't work any more hours. It is what it is. My living costs have gone up. So, I can see the ticking time bomb, and I'm going to reduce my mortgage from, 1.2 million to 600,000, because I can still sell my house for a good price. So we're seeing people gone from, bigger houses to smaller houses. We've seen people go from houses to apartments. One of my good friends actually did that just recently. Went from because they could sell the house well and they could buy the apartment reasonably well, and it just meant their mortgage was, significantly cheaper, was smaller. I do think the banks are absolutely doing everything they can to support. They don't really want to create foreclosures. It's not really in their interest, and APRA will support them with that. But rates being higher for longer, you are going to absolutely see some more pressure in the market, and it's going to force people to get out. I do think, though, you're going to see that down trading happening. So, yes, you're going to create potentially a bit more supply or listings. And this is usually going into, maybe it's going to happen in the apartment market. Investors are going to bail because the higher rates, the longer rates stay high, the more investors are going to bail. It's just the negative cash flow and the more pressure they're getting with their home mortgage. And they're just going to want to, fill the buffer up again. But I do think you're going to see people are exiting the housing market because they're downsizing a little bit. They're going to create a bit more demand at the lower end, and they're going to create a new listing at the higher end. And then, counter to that, there's a lack of listings at that higher end. And so you've got this pent up demand where people want to enter that. And so that's going to really allow that Mexican standoff to happen. And it's not going to, you're going to see this glut of people that, exiting these housing markets in these areas, and those markets are significantly undersupplied. And there's a lot of people that are, doing well because, they didn't leverage up in 2020, and they bought in 2016, and, they've done really well from working. They've paid off their mortgage, and they've got heaps of equity, and they haven't got a borrowing capacity challenge, and they absolutely can upgrade. And so they are just waiting for the right property. We have seen actually even at the top end, not this relevant for everyone, but even people in the 2, 3, 4 market that there's a number of clients right now that want to enter, above that, because that gap is actually a little bit smaller for them at the moment. There's a little bit of a lack of people willing to stretch into these bigger homes. Maybe the family money isn't there as much. There's a few listings there that people do want to downsize, for example, or maybe it's a second home. And so open homes are really, and so if a lot of those people are holding on because like, well, I don't really need to sell. But if they do find a seller that is a little bit more under pressure to sell and there's not enough demand, they have to meet the market, right? It's just a case of that. And so, but unless it's an amazing property, people don't want to make that jump. And so that would be my other, the opportunistic upgrade is there waiting in the wings. I can think of like quite a lot of clients that are pre-approved, but it's a chicken and egg problem.
Yeah, they've got to find the right place. And as we said earlier on, a lot of the stuff that's around at the moment is not necessarily the best quality stuff, particularly in some of the markets where investors are bailing and they haven't done the maintenance on properties, or in some cases, if you look at the interesting trends, SQM breaks it out between 30 days, 60 days, 90 days. There's been quite a significant rise in properties listed for a long number of months and not shifted. So that's another indicator, I think.
Yeah, that absorption rate's a really interesting one. You sort of say in days on market. I do like to look at that a little bit. And, I think it doesn't get snapped up or not. Like that's really how and that's kind of like the clearance rate a little bit. That's sort of your desperation meter. I look at that, as that goes up, it means people are willing to compromise more and more on the type of property. And so, and that's as it goes higher and higher, it means that people are more and more desperate. And I think that's sort of days on market, that absorption rate. So if you're tracking a market and, a good property comes on or a semi-good property, just go off the market pretty quick. The poorer stuff, it's hard to track. It's not so much a great litmus test, but the better stuff, if it's selling pretty fast, it means that there's a lot of buyers that are just sort of sitting there. And anyone in this, the best litmus test is actually getting out and hitting the ground. Going to open homes, going to auctions. Nothing will show you what a market's doing better than that, I believe. And so, and the thing I think people can sometimes do is they can wrap themselves up in the national story on housing prices. But really, if you just want to know what's going on, just get on the road and start getting to some opens. You'll very quickly get a good feel of how things are going.
And I think we may have said it a few times, we'll say it again now, housing is not a market. Housing is a series of markets, very different markets with different characteristics and behaviors in different locations, units and houses doing different things. So the only way is to get really intimate with those local markets and really understand what's going on the ground, rather than just to rely on the national listings or the national trends in terms of price growth. It tells you very, very little. And, things are happening quite differently. I can point to different suburbs in and around Sydney or Melbourne or Brisbane or over in Western Australia that are doing very different things from their neighbours. And it's worth just bearing that in mind, I think. Now, here's one for you from John for Joy. What are your thoughts on offset accounts? A lot of people say stay away as there are additional fees that you pay. On the other hand, of course, it means that you can potentially pay less in interest. What's your thoughts?
Look, it's they're an amazing tool. I just see them as a tool, right? To manage cash flow, to manage buffers. And, so they're not a negative thing. You can't say offset accounts aren't great, right? Like there's no negative of an offset account. It's just a savings account attached to a home loan that offsets your home loan interest. And instead of having losing that money potentially when you pay off the loan, maybe you can have redraw, but you've got that money in a savings account that you can access at any time. And there's a few changes a few years ago where ME Bank and CBA changed redraws, and I just personally wouldn't trust it as much. So money in an offset account is a savings account; they can't touch it, right? And so that's what an offset account is. Now, the fees attached to offset accounts, that's a bit of a myth, right? Potentially, if you've got a really small loan and you can get yourself a pretty bit no frills loan and it's a cheap rate and no fees, potentially. But once your loan size starts to increase over a few $100,000, the amount of discounts you can get at the banks will mean that your rate's probably similar to what you can get on one of these basic loans, if not better. And why they're better loans is those discounts are locked in for the life of the loan. A lot of these basic loans, the banks change pricing on you. They're less willing to negotiate on pricing. Sometimes they're introductory rates, etc. And so they look great now, but how do they stay competitive over the longer term, particularly if you can't refinance? Like you can easily become a bit of a mortgage prisoner. This is what the non-banks play on a little bit. is they'll give you the loan knowing that there's a good portion of them that won't be able to refinance, and that's what the banks play with these basic loans as well. And so fees on banks accounts, I mean, they do change from bank to bank. Some fees on package loans are $200, some are a bit cheaper than that, but often they're on that 300-400 mark. And you'll get a free credit card, which I think is a very small benefit, but ultimately the big benefit is getting that discount locked in for the life of the loan. And negotiating really hard there when you take out the loan. So if you walk into a branch, or the first tier pricing a bank will offer you, obviously usually isn't the best discount they'll give you. It's the broker's role to then escalate that pricing, or to compete, to also submit some competitor offers, and negotiate that discount up for you. So offset accounts are amazing. The big risk of offset accounts is, like credit cards, to be honest, is just unnecessary spending and getting sticky fingers. And, a credit card in itself isn't a big problem, right? As long as you pay it off in the time frame, and, and the fees on an annual basis aren't that much, well then, and you get some points for it, well, it's actually fine. It's where it goes wrong is if it creates more, spending, if you start going beyond your means. And it's the same as an offset account. Like if you actually use it the right way, which is basically trying to put as much as you can out of your pay each month into an offset account as soon as you get paid, and not trying to touch it, right? Because that means that money's working from day dot, and you try to leave all your savings in there, and you don't go and quickly spend it on lifestyle spending, etc. So offset accounts are amazing. Like there's no negative to them. It's just human behavior that starts to create problems, rather than sometimes people like to force savings. If I've got money in my pocket, I'll spend it, which is absolutely the case for a lot of people, right? Sometimes they're better off not using offset accounts, just because they're better off to sort of take that money away from them and actually increase the repayment and reduce loan terms and force them to save, because it's the only way they're actually going to pay their mortgages off. So that would be my thoughts on offset accounts. The other thing why offset accounts are really good actually is that you're not paying your loan off. So yeah, you're offsetting your interest, but you're not paying your loan off. So a lot of first-time buyers and and investor buyers, sometimes you get into a position where, you haven't got very little home debt. Maybe you sold your home, and you've got an investment property, and you got to buy another home. And, instead of paying off the investment property, you can put it into an offset account to offset the interest. And then you redraw that money not redraw, you just take it out of the offset to use for a deposit on a home. And the other good things, so you're not actually paying your investments, so you keep your tax deductible debt high. Another good time is when first home buyers are buying a property that's likely to turn into an investment property one day. And so what you do is you buy a property, you get a loan at 80 or sometimes up to 90%. And instead of paying off that loan, you use an offset account. And then when you're ready to upgrade, because you haven't paid off your loan and you built up your deposit in the offset account, you're able to use the deposit to buy your next home and keep your first home with a very high debt on it, which is actually now becoming an investment property. So there's tax benefits if you use it right like that, rather than just a big mistake a lot of first home buyers made is that debt is bad. I've got a home, I had a home loan on it, and I bought within my means and I smashed my mortgage down, and then they're in a really good position because their incomes have gone up and they've got all this equity in their first place. Now, I want to keep it as an investment property because they can afford to keep it and upgrade. And when you do the numbers, it makes sense to sell it, pay off the new home, and then buy another investment property, just because they structured the loan the wrong way. And so that's another thing that we've noticed over the years.
I think it's an important observation. Again, thinking about this strategically rather than just tactically, I think is quite important too. But, my thought on the offset is, pretty powerful. Pick the right bank and the right opportunity, and it can make a lot of sense. Leonie asked this question. We won't go into a lot of detail, but I will just make a couple of comments. So this is to do with the 2025 system-wide stress test for the banks. APRA basically is aping what the Bank of England did with regard to the stress test. Now, the earlier stress test that APRA did were Mickey Mouse, because they looked at each bank almost in isolation and assumed that the banks could then go to the market and essentially get funds at a reasonable level. When, of course, if everybody was in the same stressed situation, everyone would be contending for the same funds, and the price of that debt that they would actually have to issue could be a lot higher. So this is an attempt to try and deal with that. I'll be very interested to see whether, in fact, they really deal with it or not. In the UK situation, they sort of half did, but it wasn't particularly stressful at a systemic level. And so it's going in the right direction, but I think there's a lot of questions to ask about how useful those stress tests are. Chris, I don't have anything to add before we go on, but I just thought I'd answer that one quickly.
I mean, models and forecasting and, the amount of variables that go into these sort of scenario analysis. And yeah, they do a stress test, but, you just have to look at how good the RBA have been at predicting lots of different things over the years. And they do a quarterly report, which is very chunky and has some beautiful graphs in it. And go back and look at that all the way through 2020 and to now. And their expectations around property prices and inflation and interest rates. And so I don't know, maybe they do a stress test, but whether it actually played out in that order and etc. I also think, you can definitely look at that, but what does it actually mean to you as a consumer? Maybe that means that some banks go under, but what would happen in that situation? Would the other banks just buy them? And what does that actually mean? And so there's all these other things that just this order of events that, doesn't just naturally mean you can come up with this solution that this is what's going to happen. And then there's only a certain likelihood on that, and that likelihood's changing every day. And so when you're making decisions based on things like this, you got to know that decision, you probably might make a different decision on that tomorrow. And so I wouldn't try to make decisions on any of these type of things. I would just bet on long-term fundamentals. The interesting thing on long-term fundamentals around property is that we're getting really good insight into future changes to housing policy in the future with what's happening in New South Wales right now with Chris Minns and the fight between NIMBYism and the challenges of growing a population and growing a city, right? And the challenges that people who are disenfranchised, everything from renting to homelessness to first-time buyers to global talent to and what changes do we have to make at a structural level to the way that our property market is built to grow our population, still keep a society or a social desirable, right? And so that's a really interesting thing, how, they're allowing zoning changes around certain train stations, how far away from those train stations, what they're going to allow. And so if you could say, okay, well, even if that does happen or it doesn't happen, what happens if that goes round 2? What happens if that goes round 3? And can I buy a property that would still stay as a sanctuary within this new world of more housing supply? And because, if you think about it, as a city changes, right, there's less and less sanctuaries, right? And that's what people ultimately want, right? They do want that, peace and quiet, a safe place to bring up the kids in the backyard and all that sort of stuff, right? And access to the city. And so certain parts of the city will stay a certain way and certain parts will change a lot. And besides buying properties that have that development uplift, you could definitely gamble on that as another strategy. But I think this is a really interesting one to watch. Every time a story comes out, I'm absolutely looking at that. We interviewed someone from the New South Wales government on the, I forget his role, the Strata Property Commissioner. I think it was, his name was, his title was, but track that story. And you can see the Ku-ring-gai Council are fighting back. The Wallara Council's fighting back. And, whether it's heritage overlays or the powerful owl or, other reasons why housing shouldn't be allowed at these levels or, I think it's a really interesting one to watch.
I absolutely agree with you. And well, it was Chandler, the guy you were talking about, but
it's on his Strata Commissioner.
Okay.
I only interviewed him last week. I probably should remember his name, but it is 9:00, Martin, and way past my bedtime for a dad of 2 young kids and 2 cats.
I
forget the cat.
appreciate that.
One of the cats came in before. I don't know if anyone caught that.
I got one last question then, Chris, and then we'll call it a day.
No, we're good.
Yeah. Okay. So are you seeing, this is from Cookie Boy, are you seeing people being caught up with builders going bust? There was a report that said up to 4 were going bust each day at the moment. Is that something that you're coming across?
I haven't seen it as much in the last few months, but last year, absolutely. I can think of one client where multiple builders went bust. And I can think of one client, the builder walked out on the job and said, I've misquoted this, I'm out. I left him in the a right state. We've seen people off the plan sector, even though we very rarely encourage clients to go down that route, who just delay on delay and, etc. So we don't do much in the house and land packages or the new townhouses. And, we do have some clients doing builds and construction, etc., and in commercial lending, etc. So we haven't seen it as much as other brokers potentially have. But we absolutely have seen it. And we've even seen it on the small time, people doing renovations, and builders have just gone under, and some big names have all, we've seen it all in the news, etc. Yeah, it's a really horrible situation. And, I do think that makes you really not want to do a build right now. Like, the cost is, up 40, 50%. And it's all the liquidity at these builders and their risk, their ability to leverage up and push a bit harder. It's hard for them to get finance, right? And B, do they really want to, risk on right now, particularly as a lot of their profits have dwindled and they haven't got the cash to do these projects, right? And there's just a lot of risk in the development industry and the building industry. And so that's really, until things really settle, there's a really good understanding of, can, the cost of this build, and can we get the labor, and can we get the buyers, and is there enough profit in it? And until that confidence gets much higher, these numbers around dwelling, not just approvals, but actually commencements. I think, if they're getting approved, that's great. But do they start their build now, or do they start their build in 5 years' time? And I think that's what you really want to track is, and I think there's a bit of a, the infrastructure building and the government spending, and that's taking a lot of resources away from this. So that's keeping our labor prices high and our material costs. And that's another interesting story that I try to track as much as I can, together with things like the work from home story and what people are doing now. I think that's another, tectonic plate that you sort of want to track in the property market that affects things longer term.
I agree. Completions is the thing to look at. And in fact, the time it's taking to get something started through to completion is expanding out like you wouldn't believe. The costs of construction are continuing to rise. The supply of labor is continuing to be diminished because of these public sector projects that are also contending for the same labor forces as well. And of course, the 1.2 million target, which Albo is now locked into, seems quite unlikely that they'll achieve it. But it really just shows you that there's huge pressures on the sector. Just in my one-on-ones, I've had 4 or 5 people I've spoken with who've been wrestling with a builder failure. What do? They've committed to the land. Do they try and get out? Do they try and find someone else? And almost always it means paying a lot more than they were expecting to pay. Quite often they can't go back and get the additional finance that they had on day one that was actually locked in, simply because the cost of everything have risen and the underwriting standards have changed. It's an absolute mess. So no surprise to me that more people are actually steering away from the home and land package story, unless there's some mechanism to underwrite it. And I would make the point that while some of the larger builders now seem to be a little more stable, there are still cracks there as well. But some of the smaller players who were sort of hanging on last year are now where a lot of the grief is, as the asset report that came out recently made the point. So I would be very careful with home and land packages of any sort at the moment.
Yeah, and I think that, we've still got a team. Maybe I should go on that, building a school, or maybe I should do that, things with the government. I mean, that could be the government. Maybe we should do some industrial. Maybe we should do some commercial space. Maybe we should play in the build to rent space. Maybe we should, build in the aged care. Maybe we should build things that suit downsizers, and, I do some apartments on the Gold Coast. So developers absolutely go where the risk versus rewards there. And I don't think that's there in the high density market. Richard at Charter Keck, I'm trying to do, brains fading on me. He's a good man, and tracking what they do. They provide some great research on the construction industry, and they're very sound there. And so, absolutely, the green housing, I do think they're going to come back. And you are going to see. The problem is that it's owned by a few, and there's always this desire to, release land when it makes sense to release land and hold back. And, if you do believe in cults, in a country like Australia, I think that these development companies are friends, right? And they release land when it's in the interest, and they go on a merry-go-round, and I'll release, then you release, and because they don't want to flood the market, which is in no one's interest. And so I do think that will be one of the reasons I believe that APRA will cut the serviceability buffer. I think there's a lot of pressure with banks, and a lot of people, beating that drum. But I think what they'll use as the reason to do so is to support. Well, they won't say it's for the construction industry, but they'll say that first home buyers have been pushed out. Their site, which is what you were saying in Braggs, who's very pro property, and the Liberal Party's said some crazy things over the years, in my opinion. And you'll see that rhetoric is that what first home buyers are needing is higher borrowing capacity. And Shane Elliott at ANZ was kind of doing these sort of things a few months ago, or last year, which is that you are basically signing people up and forcing people out of the market because capacity is so tight. Obviously, that's in his interest to grow loan book growth and have bigger loans. It's not. I'm not sure whether he cares about the first home buyer that much, but anyway, we'll can argue about that a different day. But I think APRA servicing buffer will be a huge conversation as rates start to get cut, particularly to support our construction industry.
Yeah, well, Chris, I want to say thank you very much. We've got through, I think, the bulk of the questions, not everybody's, but most of them. And I want to say thank you for taking some time out of your very busy evening to come on and share your thoughts. I've put the link below to the Flint Group if people want to contact you. But I would also just say that Chris is also, of course, part of the Elephant in the Room podcast series with Veronica Morgan, who, by the way, will be on in a few weeks' time. And I do recommend that too. Any last closing thoughts, Chris, before we sign off?
I think we covered a lot, Martin. And one thing I love about this is that the conversation never runs out of things to talk about. And we've been doing these for 5-6 years, I think I said at the start. And, I look forward to the next one in a few months' time, because there's going to be a few different tweaks of what's changed, right? And, nothing's ever set in stone. And I think that would be probably one of the takeaways for people listening is that, you don't get too hung up on the now. It's always shifting, and new data's happening, and things are changing, and they're changing a lot faster than you expect. And don't get too, tied to an opinion, right? And I know what's going to happen, and this is what's going to, and that sort of thinking, I think you're stitching yourself up, and you're setting yourself up for failure. So let's have a chat in a few months, Martin, and I look forward to discussing what we're seeing on the ground.
Absolutely. Well, I always appreciate it, Chris, because you're right there on the front line. And thank you very much for that. I always say run scenarios, think about what if this happens rather than that, and run the counterfactual, because nobody knows what's going to happen. I want to say thank you very much, Chris. I'll take you offline now, and have a good evening. And I'm going to close the show, and look forward to catching up with you again in a few months' time. See ya. Take care.
See you later. Bye-bye.
There you go, folks. Well, I hope you enjoyed that. Insights from Chris always come very fast and furious, so always worth listening to what he has to say. And I want to say thank you for sticking with us through the end of the show. Just to tell you that next week, Damien Klassen will be on, and we're going to be talking about some of the economic things that are going on at the moment, and particularly the financial markets. The dogs are back in their basket. There you go. So we can have a quick look at the dogs before we go. And they look as though they've not moved all day, but you saw earlier on that they did. Thank you very much for spending some time with us this evening. Keep out an eye out for our other shows. We release them every day, of course, but record most of them. But go live every Tuesday. We'll be back next week as well. So this is Martin North from Digital Finance Analytics signing off. We'll see you next time. See you.